associated with investing in bonds, and what we're going to see is a long laundry list of possible risks that we can encounter. And these are certainly legitimate, but they don't all receive equal treatment within the curriculum. So for instance, if we were to go look at liquidity risk or exchange rate risk or inflation risk or event risk, we're essentially going to see one slide in about each of these in the entire curriculum, and we'll see it in this particular reading. That's not exactly true. We may see a little bit more on inflation risk later on. Okay, volatility risk, this refers to the volatility of interest rates, okay, and we will go back and visit that. We'll see it here, and we're going to revisit that concept at level 2, but I think it's going to be of secondary in nature. What we're going to see the most of, and what we're going to spend most of our time worrying about, is the big risk associated with investing in bonds. Okay, that is in interest rate risk. But then we're also going to see spend a fair amount of time, especially at level 2, dealing with call or prepayment risk, yield curve risk in the sense that, well, we'll define it in a little while. A big deal at level 1, in addition to interest rate risk, is going to be reinvestment risk. So we're going to see that those two essentially represent a trade-off. And then we'll also, of course, talk about credit risk. And if you just ask someone on the street, what's the risk of investing in bonds, they're going to probably give you a credit risk argument. That is, you're going to loan money to a company, and then they are not going to pay you back. So credit risk is certainly a key element, although it is a primary risk, and we do have some information on that in the curriculum, but you're going to see that we spend a lot of time worrying about the more technical aspects, that is interest rate risk, call risk, yield curve risk, those types of things. So I think the first side here, risks 1 through 5, actually receive more treatment. A volatility risk on this side is going to be probably an important item, but the liquidity risk, exchange rate risk, inflation risk, event risk, you certainly need to know what those are, but you'll find that you can get on top of that very quickly. So those are the different types of risk that we need to talk about over the next few minutes. So let's jump right in and see what we can learn. Now, we need to think about bond valuation a little bit as a preface to our discussion of risks. So here we're talking about discount and premium bonds. Of course, we talked about that previously when we talked about sinking funds. But when we talk about a discount bond or a premium bond, okay, well, the notion here is that when we issue the bond, the coupon rate is fixed. So the coupon rate, or the stated rate of the bond, also called the nominal rate, is the rate that is used to determine the cash flows. So at the issuance of the bond, and we've drew a little picture before, but anyway, when we issue the bond, so at time 1, 2, and 3, we're going to receive some payments, right? And if we take a $1,000 10% coupon bond, we're going to get $100 each year in interest payments, and then at the end of the life of the bond, we're also going to get the $1,000 return of principal, right? So we got to add those two things together. So if it was a $1,000 par value, 10% bond, okay, the payments would be at time 1, $100, at time 2, $100, and at time 3, $1,100. Well, remember that those cash flows are contractual. They don't change. When we set the bond at time 0, when we issue the bond, those cash flows are then set. And if they ever change, it's going to be something that a bankruptcy judge is going to have to look at, all right? So those cash flows don't change, but what about market interest rates? Well, undoubtedly in the time that you've been studying bonds, the interest rates have changed, right? So, they change every day by a little bit. So when we think of the guiding principle associated with the CFA curriculum, that is, that the value of any assets, the discounted value of its future cash flows, then what we see is that if we're changing the discount rate on this, so at one point in time it's 10%, at another point in time it's 11%, and another point in time it's 9%, as we change the discount rate, the present value or the price of the bond here is going to go up and down. Okay, we're going to deal with that in a very specific way in terms of calculations later on in the level 1 curriculum, but just for now, realize, okay, that when the coupon rate is equal to the yield. So these things that I'm calling R, I'm going to put a Y here, so we could also call that the yield. What we're really going to end up calling it is the yield to maturity, or YTM. But nonetheless, if the coupon rate, this is a 10% coupon bond, and we're valuing the bond at 10%, then the bond is going to sell for its par value. But that's the only time the bond will sell for its par value. So if the yield on the bond is less than the coupon rate, so the coupon rate is 10%, and they're only requiring a 9% yield in the market, okay, then the bond will sell at a premium. So it'll sell above $1,000, and in the event that the bond is going to sell, the yield will be greater than the coupon rate, okay, then we will see that we're going to have a case where, we've got a 10% bond, okay, we've got an 11% required return. In that case, the bond will sell at a discount. So premium and discount bonds, this is what I refer to as the pencil trick. So, if you use your thumb and forefinger as the fulcrum, well, eventually we're going to have to talk about where the fulcrum is placed, okay, but if you use that as the fulcrum on this particular slide, okay, then if interest rates go down, okay, the value of the bond goes up, right? If interest rates go up, the value of the bond goes down. So you can't bring study aids into the exam, but they can't take away your pencil. So anyway, so remember the pencil trick. Interest rates go down, the value of the bond goes up. So there's going to be some bonds that sell at a premium, some bonds that sell at a discount. We can see that quite explicitly by looking at this graph, which is the price yield function. So you can see the market yield going up in this direction, okay, and this is the value of the bond on the vertical axis. So if we're standing here today, okay, and we have an 8% bond and the market yield on that bond is 8%, then we're going to have that bond sell for par value. Okay, but as interest rates fall, so if we issued the bond at 8% and we sold it at par, that's $1,000. If interest rates were to fall to 7%, okay, well now what's going to happen, the value of the bond is going to go up. Interest rates go down, so the value of the bond goes up. Alternatively, okay, if interest rates go up to say 9%, okay, 9%, then the value of the bond will fall, right? So this is the price yield function. So when interest rates are above par over here, the bond is going to sell at a discount. When the market yields or interest rates are below the coupon yield or the coupon rate, then the bond will sell at a premium. Okay, it's probably also worth noticing, since this is the first time we've looked at this particular graph, okay, that this is not a straight line. So we're looking at this and it's a curve. This is what we call curvilinear. Okay, it's convex to the origin. So those are going to be things that are going to be important a little later on. Okay, but remember, it's not a straight line. So, here's a straight line. So what does that mean? Well, this is a curve function, and it's drawn as a curve function because that's the way it actually works. And the problem ultimately is going to be that we're going to try to estimate changes in the value of this bond, and we'll see this later on, but we're going to do it with something that is a linear measure. So if we're talking about changing, here's the initial yield we're talking about. Well, if we're talking about small changes in yield, this linear function is going to do a pretty good job of explaining change in bond prices. But if we talk about big changes in yield, okay, then we're going to start getting lots of estimation error over here in the tails because of the curvature of the price yield function. All right, so an important point. We will come back and discuss that in some detail. All right, so what about factors affecting interest rate risk? Okay, now remember, what's described there in the price yield function is interest rate risk. So how does the value of the bond change when interest rates change? Well, there's several things here that are going to be important. The two easiest to see, and probably the two that are most important, are the maturity of the bond and the coupon rate. So think of it this way. You buy a bond, and the bond has a yield of 10%, and rates go up to 11% tomorrow. So interest rates have gone up. So using our pencil trick, interest rates have gone up, so the value of the bond has gone down, right? Okay, interest rates go up, value of the bond goes down. So let's see, you bought a bond when yields were 10%. Tomorrow they go up to 11%. So your bond's coupon payments are too low, right? That makes sense? Well, would you rather be locked into those low coupon payments for 1 year or for 20 years? Well, if the coupon payments are low, then you would rather be locked in for just a year. So the longer the maturity of the bond, the more sensitive the price will be to a change in rates. So 20-year bonds are more sensitive to change in interest rates than are 1-year or 5-year bonds, right? So the maturity, higher maturity, greater interest rate risk. Okay, the coupon yield. A coupon yield might be a little harder to see, but the impact is also significant. And that is going to, what that says is, remember we talked previously about coupon versus zero coupon bonds. So a zero coupon bond doesn't give us any interim cash flows. So it just, you buy the bond today, and then you get some, the maturity value 5 or 10 or 20 years in the future. So the coupons are also on a spectrum. They can go from 10% or whatever market yields are down to 0, and that's just a number on a page, right? I mean, we can price any sort of cash flows that we want to build into the bond. Well, if the coupon is high, what that means is we are receiving big interim cash flows. So if we buy our bond with a 10% coupon when market rates are 10%, and then interest rates go up to 15%, well, if we have a high coupon, then we're going to be receiving lots of interim cash flows. What are we going to do with those interim cash flows? We're going to reinvest them at the new higher rates, right? So the higher the coupon, the lower the interest rate risk. So if you wanted lots of interest rate risk, so lots of interest rate sensitivity, you thought that interest rates were going to go down, so the value of the bond would go up. What you would want is a very long-term, very low coupon, 0 coupon bond, right? That would have the most interest rate sensitivity. Okay, also, the higher the initial yield, the lower the interest rate risk. So I'm going to go back a slide here so we can look at the price yield function. Well, what you can see is that if we look at a change in essentially the curvature here is such that if we drew it in a little more dramatic way, it'd be a little easier to see. But if we drew a very convex bond, this is one with lots of convexity, well, what you see is when we're up here at higher yields, well, as we change interest rates, well, the value over here is not going to change by very much. But if we talk about changing interest rates down here, well, the curve gets very steep on this end, so little changes in interest rates have a big impact on the value of the bond. So it is just from the shape of this curve, the fact that when you're down here, the curve looks like it's leveling out. So, we kind of drew the tail in here. Well, when you're down here at higher interest rates, the impact of an interest rate change has a smaller impact on the price axis. When you're down here where interest rates are low, well, then little changes in interest rates, okay, lead to big changes in the value of the bond. And that's a really crappy line, but nonetheless. All right, so that's more of a mathematical function than anything else. But the higher the yield, the farther we are and the more level the price yield function, the lower the interest rate risk. All right. Now, when we talk about interest rate risk, and we talk about it in general terms, these are the 3 factors that we normally talk about. So you want to make sure you have a handle on those. Long maturity, big interest rate risk. High coupon, low interest rate risk. High initial yield, low interest rate risk. Okay, also call and put options. Okay, so what we're going to say here is that a call option gives us lower interest rate risk, as does a put option. Now, you might be thinking, well, let's see, we got this call option. Interest rates go down, and then what happens? They call the bond away from us. We get all of our money back just after interest rates fall. Is that when you want your money back, when you get to invest at those new low rates? Well, of course not. You don't want to reinvest with the new low rates. So that seems like an interest rate driven phenomenon. So it seems like a call option would give us higher interest rate risk. Well, what we're going to see ultimately is that we're going to trade off 2 concepts. One is interest rate risk. The other is reinvestment risk. So if we get a call, so if a bond is called away from us, well, we're not going to see impacts on interest rate risk. What we're going to get is massive reinvestment risk. So we're going to get all of our money back at one time just when we don't want it, and we're going to have to reinvest it at a lower rate. All right. The put option, same thing. That's going to lower interest rate risk for us. And it's going to change the reinvestment side of it. So anyway, the factors affecting interest rate risk, okay, a big deal, something you certainly want to be on top of. All right, now what about a callable bond? So for the most part, the callable bond stuff, we're going to leave we're going to leave the valuation of callable bonds to level 2. So you don't have to worry about that for a while, although eventually you're going to have to deal with it. But nonetheless, we ought to think about the impact, the general valuation impacts of callable bonds. So if we start out by looking at the price yield function as we've seen it before, here specified in this solid blue line, well, what happens? As interest rates increase, the value of the bond is falling, right, over here. And as interest rates decrease, on our normal price yield function, the value of the bond is increasing, right? Well, that all makes great sense to us. So that's that in fact is what we just described. Well, if we go back and we look at a callable bond, that's one where the issuer can call it away from us at a predetermined price. Let's just think of that as par value for the time being. Well, if interest rates were to increase, the value of a callable bond goes down just like all other bonds would. But if interest rates go down, what happens to the value of the bond? Well, the point is if interest rates keep going down, the value of the bond goes up. So what if it's trading at par, interest rates start going down, so the value of the bond keeps going up, it goes to 101, 102, 105, 110% of par. Well, if the bond is callable at par, so it's callable at 100% of par, then what's going to happen is that call price is effectively going to become a ceiling on the value of the bond. So you can see that what we get here in this portion, this dashed line represents what happens to the value of a callable bond when interest rates start to fall, and the call price becomes a ceiling on the value of the bond. So no one's going to buy your bond for 110% of par if they know that tomorrow it's going to get called away from them at 100% of par, right? So people won't pay, and that's not exactly true. It can go a little above the call price depending on how far away we are from the next call date and that sort of thing, but we certainly don't have to worry about that. So the point is, what we're talking about is what happens and how a callable bond behaves differently. And what we would see is that as interest rates increase, well, we stay on the same price yield function. But as interest rates decrease, the price yield function actually starts bending backwards. Now, what do we call that? Okay, well, notice that the original price yield function that we looked at a couple of slides ago, the solid blue line, okay, it is convex to the origin, right? So here's the origin, and it's convex, so it looks like that relative to the origin. Notice that here we've actually changed shape. We're bending the other way, so what do we call that? Okay, well, if your answer was we call that concavity, well, then you're wrong. We don't have concavity in finance. We have convexity that looks like that, and we have negative convexity that looks like this. So this is called negative convexity in a callable bond, and it's just this backwards bending portion of the price yield function for the callable bond. Now, we're going to see that level 2, that creates some significant valuation issues. But here, all we need to really do is understand how the value of the bond will change in general terms, not specifics. We're not calculating, but how the value of the callable bond will change as interest rates fall, and it's described by that negative convexity. Okay, floating rate securities. Okay, well, we've talked about these a little bit already, but floating rate securities, here the coupon is reset on a periodic basis based on a reference rate plus a fixed margin. So we talked about that in the features of debt securities. Okay, so it has so what has happened to the interest rate risk is what I was trying to spit out there. So the floating rate security has interest rate risk between the reset dates. So if let's imagine an annual pay bond. So, interest rates are, go up to 5% on the reset date. So that's the day we're going to make the interest payment, or we're going to determine the interest payment for the next year. So interest rates are 5%. So we have a 5% plus, let's call it a 1.5% margin. So we set the coupon rate at 6.5% for the next year. Okay, well, what happens if the day after that interest rates go from 5 to 12%? Okay, well, we're past the reset date, so we won't get to reset again for another year. So we are going to have some interest rate risk on floating rate securities because we only get to reset on an occasional basis. So we're going to see that that on this occasional basis, we are going to get to reset, and but in between those reset dates, that is in between the coupon payment dates, the value of the bond can differ at least a little bit from its par value based on changes in interest rates. Now, what about what about the price on the reset date? So think of it this way. If we were talking about a 10-year floating rate treasury security, and there's not really such an animal, but let's pretend like there was, and the reference rate was the 10-year treasury rate. Well, what we would see is that every coupon date we would reset the security so that the yield on the security was equal to the required yield in the market. Now, what did we say about that? Well, remember, we had the pencil trick, and when the pencil's level, okay, we have the yield on the market equal to the coupon rate. So we have a flat pencil. What that says is that the bond will sell at par. But if we're talking about something that is using a reference rate that doesn't specifically describe what the required return on that security would be, that is, we're using LIBOR, which is the London Interbank Offered Rate, and we're talking about corporate debt, well, LIBOR can go up and down, and if we were talking about a LIBOR issuer, that might be a different story. But if we're talking about a corporate issuer, well, credit quality can change between or after the issuance of the bond. So if credit quality changes, what we might get is a situation where this fixed margin up here is no longer correct. So when we started, this issuer would say, okay, I'm going to pay LIBOR plus 150 basis points. That's my required return. I can buy and sell debt all day long in 150 basis points. But once we issue the debt, then the firm falls on some hard times. There's deterioration of its credit ratios, all that sort of stuff. Maybe it really needs a 200 basis point spread in order to be able to return the bond to par value. But since the margin is fixed, okay, that won't change during the life of the bond. So what that means is at every reset date, okay, the bond may not go all the way back to par value because the margin over the reference rate is no longer appropriate. So as long as this margin was appropriate, then the bond would reset to its par value on every reset date. Okay, but if the margin is not appropriate, given the credit risk of the firm, then we're going to have the problem that it will eliminate interest rate risk across periods, not within the period, but across periods, but it may not go all the way back to par value because interest risk or credit risk has changed on the bond during the life of the issue. All right, so what about a floating rate securities problem? Which of the following regarding floating rate notes is false? Okay, the coupon rate is based on a short-term reference rate plus a margin. Well, that sounds reasonable to me. Okay, so a cap benefits the issuer of the floating rate bond. That also seems reasonable. A floating rate note will be valued at par at every coupon reset date. Okay, well, of course, that's the one that we just talked about. And we said that's not true because the margin may not be appropriate for the security after issuance. So they could trade at 150 basis points above LIBOR when they issued, but because of changing credit, they really needed to be at 200 basis points, but that margin doesn't change after the issuance of the bond. All right, let's talk about interest rate risk. And I'm a little mixed about what to tell you here in the sense that we're going to see a much better specification of this form. It's actually the same thing. It's just written in a more neat fashion elsewhere in the Level 1 curriculum. But this is getting to one of the prime concepts, one of the biggest things that we'll see in the Level 1 curriculum. Actually, I think this is one of the big concepts of the Level 2 curriculum also. So you're going to learn this now. You're going to get paid for it twice. But that is the idea of the duration of the bond. So what is duration? Well, here's the point. A few minutes ago, we were talking about interest rate risk, and we said, look, there's three things at least that impact interest rate risk for a plain vanilla bond. Let's get away from the callable stuff for a while. So that was the time to maturity, the coupon rate, and the initial yield. Were we at high yields or were we at low yields when we started talking about this bond? So there's three things that impact interest rate risk. So how can we describe the interest rate risk of an individual bond? Well, what we're going to see is that we can calculate this number that's called duration, and duration is an index to price sensitivity. Okay, that is, the higher the duration of the bond, the greater the change in the value of the bond to a given change in interest rates. So if we look at two bonds, one's 10 years to maturity, one's 12 years to maturity. Okay, one's got an 8% coupon, the other's got an 11% coupon. They've got different initial yields, whatever it happens to be. We've got multiple factors that create interest rate risk, but when we look at duration, we bring all those into one number. So the higher the duration, the greater the interest rate risk. Okay, and this is something that you absolutely need to learn here on the top. So there's number of interpretations for duration. Okay, it's an index to price sensitivity, higher duration, higher interest rate risk. It's also sometimes thought of as the weighted average time to maturity. That's not actually the way we're going to calculate it, but that's the way it was originally calculated. So sometimes we still see duration measured in years. Okay, that's not strictly appropriate, but some people label it that way today anyway. So we talk about a duration of 5 years or 6 years. That's the weighted average time to maturity. Okay, but the best definition is that the duration is the approximate percentage price change for a 1% change in yield. So if we have a duration, and we'll come back and look at the formula in just a second, but if we have a duration down here of 4.29, hey, then what that tells us is that if interest rates go up by 1 full percentage point, if interest rates go up by 1 full percentage point, then the value of this bond is going down by 4.29%. So inverse relationship, right? Interest rates go up. We know the value of the bond's going down. But how far down is it going? If interest rates go up, the value of all bonds are essentially going to fall. Essentially, all bonds will fall. Okay? But some bonds are going to fall by a little bit. Some bonds are going to fall by a lot. Duration tells us how much that fall is going to be. So duration is the approximate percentage price change for a 1 percentage point change in yields. Now, how do we calculate that? Here's a formula. We're going to see this again in a few readings, so I don't think you need to worry too much about it here. But what we're going to do, this is actually a duration, a way of calculating duration that is fairly straightforward. Also, I would imagine that they're going to give you most of the inputs on the exam. So what we're going to do is we're going to start out, we're going to look at the bond, we're going to say, oh, look, today the bond has a 10% coupon, and it's trading for, let's say, $1,000. To keep it easy, it's trading at par. Well, what we're going to do is we're going to shock the interest rates. So it's got a 10% coupon. We're going to shock interest rates up by, call it 50 basis points. Then we're going to shock interest rates down by, call it 50 basis points. So what's going to go in the numerator here are the shocked values of the bond. So if we shock interest rates down, the value is going up, inverse relationship, right? If we shock interest rates up, the value is going down. So we're going to get what I refer to, and how I'm going to refer to this later, is P sub minus here. That's the price of the bond when interest rates fall. And here we're going to get P sub plus. That's the price of the bond when interest rates increase. So those are shocked values. We go through, we're going to use our little valuation technique. We're going to say, here's the value today. Okay, we're going to shock that, shock the yield up, shock the yield down, get the numerator, and then the denominator 2 times whatever the price is today, given what yields are today, times the shock that we applied. So we could have applied a 50 basis point shock or a 25 basis point shock or a 100 point shock. Okay, anyway, the point is, since we're putting this the decimal change in yield in here, we are essentially standardizing this to 1 percentage point in our definition. So what that means, and we're going to have some examples of it later on, so don't get too bogged down in the calculation of duration here. Hey, but we do want to understand where this comes from, and it is a mega important concept. So if the market yield goes up by 50 basis points, 0.5%, the price of the bond is going to go from 980 to 960. So 980 is the value today. Okay, so if interest rates go up by 50 basis points, the price is going down to 960. So that's the shock when interest rates increase. That's P sub plus. Okay, if yields go down, so now we're going to shock interest rates down, okay, by the same amount, then the price goes up to 1,002. So we have P sub minus and P sub plus. Here's my, P sub minus there, and here's my P sub plus from above. Okay, and then we're going to divide that by 2 times the initial yield times the change. Notice that 0.005, that's 50 basis points, right? So that is a 0.5%. And that gives us a duration of 4.29. So we plug into that, and that tells us that if interest rates were to change by exactly 100 basis points, then the value of this bond would change by approximately, remember that you don't see any higher order terms in this equation, right? So this is a linear function. When you look at the price yield function, it was curved, right? So I told you, oh, we're going to run into a problem where we're going to estimate price changes with a linear function. Okay, well, here's the linear function that we were talking about. So anyway, so the point here is if interest rates increase by 100 basis points, the value of this bond is going to go down by 4.29% from this $980 value that it has today. But since this is linear, we can also use this same relationship for any hypothesized change in yield. So what if we thought yields were going to change by 0.25%? So we think that, what happens if yields go up by 25 basis points? Okay, that is 0.25%. Well, if yields go up, we know the price is going down by how much? Well, we take duration times the change in yields. That's going to tell us the approximate percentage price change, right? So in this case, the price is going to, let's see, if yields go up, the price is going to go down, and it's going to go down by 1.0725%. So how do we translate that into dollars? If we talk about a bond that is worth, bond portfolio that's worth $2.5 million. It has a duration of 4.29. We're expecting a 25% change in yields. Then we're going to take the duration times 0.25, multiply that by the value of the bond, and what we would expect to see here is that if interest rates go up by 25 basis points, then the value of this $2.5 million portfolio is going to fall by $26,812.50. Okay, we can also turn this into what's called a dollar duration, and a dollar duration is a concept where essentially we're talking about the same thing, but we're just going to take a 1 percentage point change in yield, multiply that by the duration, and we're going to say, well, for a $2.5 million portfolio, a 1 percentage point change in yield is going to lead to a $107,250 change in value. So we can either specify it as percent, 4.29%, or if we know the value of the portfolio and want to think in terms of dollars, we can change it into a dollar duration, and that would just say for every 1 percentage point change in yields, okay, there's going to be a change in the value of the portfolio of $107,250. All right, now what about the idea of yield curve risk? So remember we looked at this long list of different types of risks, and here I said one of them was yield curve risk, and we would talk about what that is. So we've actually alluded to this already, but here's the notion. And when we talk about the duration of a portfolio, and duration is a lot like beta in that the duration of a portfolio is just the weighted average of the durations of the individual assets in the portfolio. I'm going to say that again because I think it's important. The duration of the portfolio is nothing but the weighted average of the durations of the individual bonds in the portfolio. But portfolio duration is an approximate percentage change, okay, or an approximation of the price sensitivity of the bond to a parallel shift in interest rates, okay, or a parallel shift in the yield curve. So the yield, then what that says is the yield on all bonds is going to change by the same amount. So, and I've got a picture of that on the next slide for you. But if we have a non-parallel change, that is going to be that we'll say long-term interest rates go up by more than short-term interest rates, so the yield curve becomes steeper, okay, well then the portfolio duration is going to do a less good job of describing the change in the value of the portfolio. So if there's a non-parallel shift in the yield curve, the yields on the different bonds in the portfolio can change by different amounts. So what we refer to as yield curve risk, okay, the interest rate risk of a portfolio of bonds that is not captured by duration. So in other words, duration is a pretty good measure if we're talking about small changes that are parallel. If we talk about big changes, or if we talk about non-parallel shifts, then the approximation that duration offers us will become worse. All right, so here's a picture of the yield curve. So this is just the maturity of bonds on this axis, okay, against the yield on bonds. And what we would see, and we'll spend some time worrying about this at level 2, but what we see here is that it's normally upward sloping. So if you go out and you look at a 1-year bond, it has a lower yield than a 2, than a 3, and then you come all the way out here, to 30 years or whatever it happens to be. So this is called the yield curve. And what we're contending here is that, or what is the case, I don't think we're just contending that, is that when interest rates change, we want to understand the sensitivity of our bond portfolio to a change in interest rates. That's what interest rate risk is. Well, if we have a parallel shift in interest rates, so here we see a parallel shift, notice that short-term rates and long-term rates increased by the same amount. Okay, that's a parallel change in interest rates. Well, duration is a measure that describes what happens to the value of the portfolio when we have a parallel shift. Unfortunately, most changes in interest rates would involve some non-parallel attributes, which is something we get to investigate more at level 2. But here we see that long-term interest rates increased significantly while short-term interest rates actually fell. This is what we would call a steepening twist. Don't think you need to worry about that word, at least not until level 2. It's a steepening twist. Notice that the shape of the yield curve, the slope of the yield curve, it's now steeper, right? So this is a non-parallel shift. Well, if we have a portfolio, we calculate the portfolio duration to be 4.29, and we want to say what happens if interest rates change by 50 basis points. Well, we can do that, but what we're assuming in that calculation is that the change is parallel, and of course we observe lots of non-parallelness in the change in interest rates. So interest rates change in funky ways, and that's going to make the approximation that we get from the duration measure less robust. Right? So the duration is great if we're talking about parallel shifts and we're looking at small changes in interest rates, 20 basis points. But if we're looking at what's going to happen with, a 150 basis point change and it's going to be non-parallel, then the approximation afforded us by duration is going to become worse and worse. All right? Okay, callable and prepayable securities. So here we're looking at callable securities, and they're likely to be called when interest rates are low. So if you live in the United States, then you have a prepayable mortgage. So if interest rates go down, what do? You refinance your mortgage, right? So I'm thinking about doing it right now. So interest rates have fallen since I bought my home, and I'm thinking, well, I ought to go out and refinance because I can get a lower interest rate, and that's going to lower my monthly payments. Corporations have the same incentive. Interest rates fall, that's when they call the bonds, all right? So the call is likely to happen when interest rates fall, which means that from the bondholder's point of view, they get all their money back just when they don't want it, just when interest rates are low. So principal repayment on prepayable securities is faster when interest rates are low. So if you think of, again, we're talking about asset-backed securities. We haven't had a lot of chance to talk about that yet. Going to be a big topic at level 2. But basically, we're going to take lots of little mortgages, okay, and we're going to put them together in a big bucket, and we're going to issue bonds that represent a claim against an undivided interest in that bucket of mortgages. Well, what happens if interest rates fall? Well, some people, not everybody, because we have all these little decision makers out there, but some people are going to refinance. So the principal repayments on a prepayable bond are going to speed up when interest rates are low. That means that the investors must reinvest the principal just when they don't want to. So you don't want your money back when interest rates are low. You'd like your money back if interest rates were high, but then no one calls the bonds when the interest rates are high. All right, let's talk about reinvestment risk. So we've talked about interest rate risk. Changes in interest rates impact the value of the bond. That was the pencil trick. Pretty easy to keep track of that. Reinvestment rate risk refers to the amount of return that we receive from reinvesting interim cash flows. So once again, let's make sure that we understand what's going on in this calculation. When we talk about valuing a bond, and we've been using this example of a 3-year security, so I'll stick with that. So here's 1, 2, 3 years, okay, and we have these payments that are coming in. We said they were going to be $100 in the first year, $100 in the second year, and then they're going to be $1,100 in the third year, right? Well, we haven't got to bond valuation yet, but what we're going to find is that we're going to calculate something called the yield to maturity. So the YTM, well, the YTM is going to be calculated in a very particular way, and the way that it's going to be calculated is going to assume that all of the interim cash flows are reinvested until the end of the life of the bond. So we're going to buy the bond today at time 0. 1 year from today, we're going to get a coupon payment of $100. Matter of fact, this is the same calculation, the same thing we run into when we talk about internal rate of return. Yield to maturity and internal rate of return are the same thing, all right? So when we talked about using internal rate of return in corporate finance, same problems. So we're going to get this $100 and we're going to reinvest that until time 3. And then at time 2, we're going to get the $100 and we're going to reinvest that until we get here to time 3. So this yield to maturity is going to depend on the amount of reinvestment income that we generate over the life of the bond. All right. So if we have this bond and we have a yield to maturity, let's call it 11%. So what that says is, in order to actually earn 11% on this bond, and we're going to examine this in more detail later, in a lot of detail in level 2, but what that says is, when we get this first $100 payment in, we have to reinvest that at 11% for 2 years, and when we get this second $100 payment, we have to be able to reinvest that at 11% for 1 year. And the income that we receive, so you take the payments plus the reinvestment income, that's where we're going to get the yield to maturity. If we earn anything other than 11% on our reinvested cash flows, then we will not actually earn the yield to maturity. So when we talk about reinvestment rate risk, what we're talking about is the return that we're earning from reinvesting the interim cash flows. So what is it that's going to make reinvestment risk higher? Well, obviously, the higher the coupon, the greater the reinvestment risk. The more the bond's yield is going to be dependent on earning a return on those invested coupons. If you have a 0 coupon bond, Okay, well, what is the reinvestment income there? It's zero, right? So you don't have any interim cash flows. But as you have coupons, as they get bigger, you have more cash flows that have to be reinvested. That means you have more earnings on those cash flows. The yield to maturity will depend more critically on higher coupon bonds. Okay, if the bond has a call feature, what that means is when interest rates go down, the bond gets called, we're going to get all the money back at one point. That means we're going to have to reinvest all of the money, not just the interim payments. Well, that obviously is going to drive up reinvestment risk. If the security is amortizing, that means we're getting some principal and we're getting some interest every month. Okay, well, what is that telling you? Well, if you're getting, on some bonds, we're just getting principal. On other bonds, we're getting principal plus interest. That's the same thing as saying we're going to get large interim cash flows. So if the bond is amortizing, we're getting lots of cash back during the life of the bond. That means we have to be very careful about our reinvestment strategy. And then if a security contains a prepayment option, really, we've already talked about that because the prepayment option for the amortizing securities is really the same thing as the call feature for the non-amortizing securities. So 2 and 4 here are really getting at the same point, I think. All right. Anyway, so if you want, we have interest rate risk, we have reinvestment risk. We went through a list of factors that increased interest rate risk. You ought to be aware of those. You also ought to have a good handle on this reinvestment rate risk thing. And we'll get to talk again some more about this later on when we do valuation. What about credit risk? And so credit risk is obviously a paramount concern for bond investors, in particular if you're investing in risky bonds, that is any bond that is not risk-free. So bond ratings are a measure of the probability of default. So when we talk about AAA bonds or AA bonds or C bonds, okay, those are bonds that are ranked by their probability of default, not by necessarily their investment value. So when we talk about credit risk, the mother concept here is default risk. So we want to know, is the firm going to default on that bond? Okay, well, if they are, then that's going to, of course, generate big losses. And the credit rating, that is AAA, AA, single A, triple B, whatever, will speak to the probability of default. So AAA bonds, those are the highest quality. Those have the lowest default rates over time. AA bonds, single A bonds, triple B bonds, and so forth. The lower we go down the rating scale, the greater the risk of default becomes. Now, this is the mother concept, but there's two related attributes. One of those is downgrade risk. So that's the idea that you bought a bond when it was a AA bond. So, you went out and Moody's or Standard & Poor's, whoever, had given it a AA rating. Okay, and you bought it and it had a yield for whatever was appropriate for AA's at that time. But then during your holding period, the firm falls on hard times, right? Their ratios start to deteriorate, their operating profits are falling, their products are becoming obsolete in the marketplace, whatever it happens to be, and they get downgraded to an A. Still a good rating, but they get downgraded. Well, what happens when the bond gets downgraded? Okay, well, that means there's going to be an increase in the required return on the bond, right? So that means the yield on your bond is going to go up. Well, remember the pencil trick, right? If the yields go up, the value of your bond is going to fall, all right? Also, related to this downgrade risk is the idea of credit spread risk. So credit spread risk, and we're going to ultimately see that spreads are the way we think about bond valuation, but credit spread risk, this is the difference, and we have to be careful about this. It's called the nominal spread, but I think the intuition here is good. Okay, the spread is the return on your bond minus the return on the comparable maturity treasury. So if you've got a AA bond, okay, and it has a rate of, let's call it 7%, just as a number. Okay, well, that's supposed to be a percent sign. Anyway, 7%. And then we look at the treasury, the same maturity, and it has a 5%. That would be a really wide spread, for a AA bond. But nonetheless, we'd say there's a 200 basis point spread there. All right. So that would be the nominal spread. Well, what happens if people become more worried about your bond repaying? Well, then the interest rate on your bond is going to go up, right? As the market becomes more concerned with whether or not this company is going to be able to pay, well, that means the spread is going to be widening. So again, the interest rate relative to other bonds is going up. The value of your bond is going down. So three related but separable ideas with credit risk. One is the probability of default. Two, the risk that we could be downgraded because the probability of default is increasing. And three, the spread could widen because market investors are now more worried about the probability of default on your particular bond. All right, so credit risk, big deal. Certainly a big deal in the real world. We're going to have some more investigation of that later. In particular, we're going to see some investigation of it at level 2. But we don't have a lot of technical things we're going to have to worry about here like we do with reinvestment risk and interest rate risk, as you will see in coming readings. Now, what about some of the other types of risk? Liquidity risk. So liquidity obviously is a big deal. So the better the liquidity, the smaller the bid-ask spread. Well, what happens if a bond has a decrease in liquidity? That's going to increase the bid-ask spread. It's going to lead to a lower sale price, okay, and decrease the returns on the position. So if we see, just like anything else, liquidity is an important attribute of a security. If that attribute worsens, okay, the returns are going to be poor. So anyway, here we're talking about it through the function of the bid-ask spread. So the bid-ask spread gets wider. Okay, well that just means that you are going to have to, your returns are going to be lower. Even if you were, holding the security till maturity, it would still be a big deal, because if you had to mark the security to market, that is, you had to go in and revalue it for, regulatory purposes, you would still show lower returns on that bond. What about exchange rate risk? Well, here, if you have an investor that's buying a security denominated in a foreign currency, so suppose you're a Canadian investor and you buy a Japanese yen denominated bond. Okay, well, what happens if the foreign currency, in this case the Japanese yen, depreciates? Well, if you get, you're receiving Japanese yen, they become worth less. Each one of them you receive is worth less than it was when you started. Well, that's obviously going to reduce the return to the Canadian dollar-based investor. Okay, exchange rate risk, well, this is really the same thing. Okay, but the actual cash flows from the investment may be worth more or less than was expected when the bond was purchased. So you may be the Canadian investor buying a Japanese yen denominated bond. Well, if the Japanese yen, exchange rate goes way up, so the value of the yen goes way up, so there's a bunch of unexpected appreciation. Well, that's going to enhance your return. But your returns are going to be dependent on the value of the foreign currency is the point. What about inflation risk? Hey, inflation risk is pretty straightforward. So this is the idea that the prices of goods and services increase by more than expected. So you were, you were allowing for 2% inflation. You were going to retire in 20 years. You bought a 20-year bond. You looked at the yield. You said inflation is going to be 2%. Here's how much purchasing power I'll have in the future. Okay, well, the increasing price level decreases, okay, the amount of goods, the real goods and services that the bond payments can purchase. So in other words, you got exactly what you thought you were going to get in terms of number of currency units. Okay, you received them exactly when you thought you were going to receive them, but you still didn't have enough money to buy both food and medicine in retirement. All right, so the idea that inflation is going to be higher than expected, you got your actual payments, okay, but they just don't buy as much as you were hoping. All right. What about yield volatility? And I think that this is something that you want to pay some attention to, because it's easy to write questions on, and it certainly is one of the things that determines is something that separates out those people that were paying attention from those who were not paying attention. All right, so we haven't covered bond price. If you're going straight through this curriculum, through the level 1 curriculum, through the video series, and you're just now to fixed income, then you haven't got yet to option valuation. All right, but when we get to option valuation, what we're going to see is that there are several characteristics or several attributes that impact the value of an option. And I don't want to give a lot of those away at this point because we're not there yet. We'll discuss them in great detail when we get to the derivative material. But one of those would be volatility. Okay, and what we're going to contend here is that options are a volatility play. Right, so if we increase volatility, that is going to increase the value of an option. Okay. That is always going to be the case. If we increase volatility, we increase the value of the option. So you can think about it this way. If you know anything about how an option works, if we look at this over time, okay, and here is the exercise price. Well, would you rather have a security that does this, or would you rather have a security that does this? Okay, well, remember, with an option, if it's out of the money, so if we're down here, we're out of the money, you don't have any big losses. but if the price runs way up, then you do get big gains. So the idea that you could have big gains without offsetting big losses means that the greater the volatility, not necessarily, we're not talking about a change in price here, but the volatility of price, the greater is going to be the value of the option. All right. Now that also pertains to embedded options. So here we're talking about, get rid of some of this. Okay, so an increase in yield volatility increases option values. We just talked about that. So if the volatility of interest rates goes up, then the value of the embedded call option or the embedded put option is going to be greater. Okay, so volatility increases option values. And again, when we talk about, we're not talking about the level of interest rates. So if you're looking at this over time, one more picture. Okay, so here's time, and we're going to measure that against rates. Okay, well, if we're talking about interest rates going along like this, and then they're going to jump up, okay, and they're going to be like that, that's a change in rates, right? Okay, we're not talking about a change in the rates themselves. What we're talking about is a change in the volatility of rates. So if rates were normally, they go up and they go down a little bit like this, okay, well that's one level of volatility, right? But then if for whatever reason they become more volatile, there's more Fed interaction or whatever it happens to be, well that's going to make these embedded options more valuable. So yield volatility, not the level of yields, but an increase in yield volatility will increase the value of the embedded options. Well, here's the point. If we're talking about a callable bond, then what we have is the same thing as an option-free bond, and then we have sold a call to the issuer. So if interest rate volatility increases, then the value of the call option to the person that issues it, the issuer of the bond, is going to be greater. Well, so what's going to happen to the value of the callable bond? Well, the option-free bond does not change with volatility. It changes with the level of interest rates, but not the volatility of interest rates. But the value of the call gets bigger. Then, as volatility increases, the value of a callable bond has to fall. So increases in volatility decrease the value of a callable bond. With a puttable bond, it's us, the bondholder, that owns the option. So we have the option-free bond, plus we have the value of the put option. If the put option becomes worth more because volatility increases, then that will drive up the value of the puttable bond. So the effects of yield volatility, because as yield volatility increases, the value of the embedded option increases, it will increase the value of the puttable bond, it will decrease the value of the callable bond. All right? Couple of more slides here. So event risk, this is just something that this really could be titled the everything else risk. All right. So, what if you have some sort of big natural disaster? You're talking about something like Knott's Berry Farm in California. Most of their operation is in one place. If they have a big earthquake there and that messes up their facility, well, that's going to have an impact on the firm's ability to service its debt. There's also corporate restructurings. There could be regulatory changes that are going to impact the ability to repay the bond. These are things that are hard to anticipate, but relatively easy to diversify away. They're very firm specific, so that's event risk. So you ought to know what it is. Let's finish out this section. Oh well, we need to make sure I didn't skip a. Okay, so talking about sovereign risk. Okay, so for sovereign risk here. We're talking about sovereign bonds, that is issuing bonds that are issued by federal or national governments. Okay, well, sovereign bond credit spreads can increase, right? So looking at the spread between, let's say, a bond offered or issued by the government of Brazil and the government of the United States. Okay, well, if the Brazilian government becomes less creditworthy, and I'm not saying that's going to happen, I just used that because that's the first country I thought of. Okay, then we could see those spreads increase, and the return on those Brazilian government bonds would in fact be lower. So the foreign government's credit rating can decline. The foreign government can in fact default on a bond, or they can place a moratorium on payments. So and there's just not much we can do about it. So the origins of sovereign risk are most often low economic growth, tax revenues, and high government spending. So it sounds a little bit like the United States. All right, what about interest rate risk? Here's a quick problem. A bond's interest rate risk will increase with what? A put option. Okay, a shorter maturity or a lower coupon. Well, remember, the options decrease interest rate risk. They massively increase reinvestment risk is the jargon we have to use there. Shorter maturity means less interest rate risk, but lower coupon means that we're getting more of our cash flows where we are effectively not able to reinvest our cash flows to take advantage of yield changes. So high coupons reduce interest rate risk. Low coupons increase interest rate risk is the intuition that you need there. And then finally, an increase in yield volatility will most likely decrease the value of a callable bond, decrease the value of a puttable bond, decrease the value of all option-free bonds. Remember, yield volatility does not impact option-free bonds. It only impacts the option-like characteristics of the bonds with embedded options, that is callable and puttable bonds. And since if there is a yield volatility increase, okay, that means the value of the embedded option is going to go up, but it is the firm that owns the call option. So we have the option-free bond minus the call option. The call option is going up in value. We're subtracting off a bigger number, so we're going to get a decrease in the value of the callable bond as a result of an increase in yield volatility. And that is the risks associated with bond investing. A little more technical than some of the other material we'll see in the study session, but certainly something that is easy to write test questions on and something that you want to make sure you're on top of.